welcome back. This is episode 19 of Three Clowns, and it's Thursday, April 30th. We've got Meta and Alphabet going completely opposite directions overnight, a data dump that hits in about 3 hours, and oil still hanging around 120 so. The markets basically got to process an earnings shock, inflation data, and a supply crisis all before we grab lunch.
Morning. I'm awake against my will.
Morning, guys. Tom, I'm with you. I think my soul is still back in bed, but the coffee is doing the heavy lifting today. Yesterday, I spent 20 minutes looking for my car keys, only to realize I was actually holding them the whole time. So, if I sound a bit slow to get the gears turning, that's where we're starting from.
Yesterday, I watched a guy parallel park for so long the meter expired before he finished. Then he drove away like it was a strategic decision. I respected it. At some point, it's not parking, it's research.
Oh man, the level of commitment to a failure is actually beautiful. It's like he was conducting a feasibility study on the curb, then just decided the data didn't support the move.
Alright, so Meta just got absolutely demolished, down 8.5% pre-market, and Alphabet punched straight through their number and up 6%, which is the kind of thing that usually tells you something about the whole ecosystem. But here's the thing. The Nasdaq's basically flat, despite the fact that the two biggest pieces just went in completely opposite directions, which means the rest of tech is doing a lot of the heavy lifting to keep things from falling apart. Then you've got the data tsunami hitting at 830 DTT, core PCE, the whole employment cost number, and oil's still sitting above 120 because apparently the UAE decided to quit OPEC effective tomorrow, so we're basically processing an earnings shock, an inflation signal, and a supply crisis all before lunch. And if that wasn't enough, Starwood REIT halted redemptions last night, which is real estate quietly screaming into the void about what liquidity actually looks like right now. Meanwhile, KKR and Energy Capital are circling DCC with a takeover approach. France just pushed an aggressive fossil fuel phase-out at an energy summit, gold sliding for a third day straight as the Fed keeps signaling hawkish. The crypto complex is bleeding. Coinbase down on liquidity fears. Nigel Farage is caught hiding a £5 million gift from a crypto billionaire, which is a timing thing. ASX named Darren Yip interim CEO, while they search for permanent leadership. Avalon Bay and Equity Residential are in Hong Kong's locab. By day, Tom, you watching the earnings, or are we going straight to the data?
It's the cleanest A/B test you're ever gonna get. Alphabet just told you intent-based ads are still basically a tax on being online. Meta told you interruption-based ads get expensive the second the economy even thinks about slowing. And the spend line matters. Meta's pouring money into AI just to stand still. Google's using AI to defend a monopoly that already prints. The market's not confused. It's saying one of these is infrastructure and the other is optional. I'm watching if Microsoft trades like Meta or like Google. That tells you whether this is company-specific or the start of budgets tightening everywhere.
Tom, that infrastructure versus optional distinction is spot on. It's like watching people decide which utility bill to skip when the rent goes up. But the real story for me is that the 10-year yield isn't even flinching at the Meta carnage. It's actually up to 4.418%. Normally, you'd see a flight to safety into bonds when a massive tech name gets gutted, but the oil supply shock and that UAE exit are basically telling the market that inflation is sticky and getting stickier, which keeps yields pinned up regardless of the earnings mess. Then you look at Starwood halting redemptions. That's the Fed's higher for longer policy finally breaking the plumbing in commercial real estate because they can't refinance at these rates without a total wipeout. We're heading into this GDP and core PCE data at 8:30 with the market already on edge about stagflation. So if that employment cost index comes in hot, the Fed's hands aren't just tied, they're basically superglued to the no-cut button.
So the question is whether we're looking at a meta problem or a system problem, and we're about to get the data that answers it. Let's dig in. So here's what the tape's actually telling us this morning. And it's weirdly clean if you look at it straight. Meta got absolutely demolished, down 8.5% pre-market, because they just told you that when the economy gets tight, interruption-based ads get real expensive real fast. They're pouring money into AI infrastructure just to defend a shrinking ad load, and the market's saying, yeah, we're not paying for that. Meanwhile, Alphabet punched straight through and up 6% because intent-based search ads are still basically a tax on being online. People need information. Full stop. And Google's already got the monopoly. It's not an A-B test of earnings. It's an A-B test of what actually survives when spending gets nervous. But here's where it gets interesting. The broad tape underneath this earnings shock is doing something the Fed probably wasn't expecting. Oil ripped back over 120 yesterday after Trump signaled the Hormuz standoff could drag, and the UAE just said we're quitting OPEC effective tomorrow, which is the clearest signal yet that cartel cohesion is cracking, and supply uncertainty is actually going to stick around. XLE was up 2.3% yesterday, USO up 7.9% FURIs. That's energy getting bid on geopolitical risk, which normally would crush defensives and send gold flying. Instead, gold's down for a third straight day, GLD falling 1.07% yesterday, and that matters because it tells you the market's not buying gold as a hedge. It's buying gold as a speculative position, and when the Fed signals hawkish and real yields creep up, speculative hedges get dumped. Then you've got Starwood REIT halting redemptions after the bell, which is real estate code for we can't hit our NAV without a fire sale. And that's the first real visible crack in what higher for longer actually does to commercial real estate liquidity. Avalon Bay and Equity Residential are in merger talks this morning, which could be growth or could be desperation. We'll need to see the deal terms. And crypto's bleeding on the same liquidity fears. Coinbase down 6.5% yesterday. Bitcoin down 1.3% overnight. Because when the Fed signals sticky rates and the oil supply shock makes everyone nervous about cash, risk capital gets nervous about duration. So the question for me is this. Is the Meta miss telling us that ad budgets are contracting economy-wide, or is it specific to the fact that Meta's already lost ground to TikTok and they're just playing defense? Because if it's the first one, then the Starwood redemption freeze and the crypto bleed are the three-part warning. If it's the second, then Google just proved that moats still work. Tom, where are you landing on whether this is structural or just a reset inside the ad stack?
It's both, but the tell is Microsoft quietly down 1.5. They don't have a TikTok problem. They have an enterprise maybe pauses spend problem. If this were just Meta losing share, Microsoft wouldn't be leaking here.
That's the move, right? If enterprise was actually fine, Microsoft wouldn't be down here. So we're looking at a broader pause in discretionary tech spend, not just Meta getting cleared out by TikTok. So we're looking at a broader pause in discretionary tech spend, not just Meta getting cleared out by TikTok. That changes everything because it means the ad market isn't contracting, it's just reallocating. And if enterprise is pausing, it applies to everyone, which actually ties directly into what's happening on the other side of the tape right now. Oil's back over 120 WSO was up 7.9% yesterday, and the UAE announcing they're leaving OPEC effective tomorrow is the first structural crack in cartel discipline we've actually seen. XLE up 2.3%, energy infrastructure getting real attention. And here's where the private equity bid gets interesting. DCC just fielded a takeover approach from KKR and Energy Capital Partners. That's not a defensive move. That's private equity saying infrastructure assets tied to supply uncertainty and higher for longer energy costs are actually a buyable asset class right now, because you can lock in inflation pass-through and you don't have to worry about demand destruction. Pipelines and midstream don't care if people stop buying things. They care if the molecule has to move. It's the same logic Tom just laid out for Microsoft. Infrastructure is the only place where you get both pricing power and mandatory usage. Energy infrastructure is cheaper and less crowded than data center buildouts. And if Hormuz stays fractious, you're effectively long geopolitical insurance plus a real asset hedge. That's why Amazon is up 2.55% pre-market and acting like a relative haven. It's got the AI optionality, but it's also got logistics and energy infrastructure exposure baked in. The tape's basically drawing a line right now. Optional stuff gets paused. Mandatory infrastructure with pricing power gets bid. Ray, you've got thoughts on whether Starwood halting those redemptions signals the same pressure, or if that's a different animal entirely?
It's the same animal, Alex, just wearing a different suit. Starwood is what happens when the Fed's higher for longer math finally breaks the spreadsheet. Yesterday, I was looking at their debt schedule, and you realize there's just no bridge left. When you can't refi $100 million in commercial paper without a 40% equity wipeout, you don't sell assets into a fire. You lock the doors and freeze redemptions because it's the only move that keeps the lights on. It's not a management failure. It's just the inevitable end state for leverage when the cost of carry stays this high.
Ray's right. It's not a surprise. It's just math finally catching up with the spreadsheet. And here's the thing, if this morning's data, GDP, core PCE, ECI at 8:30 comes in hot enough to keep the Fed honest on rates, staying higher, then Starwood stops being an outlier and starts being a template. Every leveraged real asset holder is running the same calculation. Right now, the tape absorbs it if inflation looks transitional, it spreads if inflation looks sticky. We'll know in about 4 hours. Ray, the deeper policy and geopolitical threads are in the footnotes. You've got those?
I've got them right here, Alex. And honestly, after seeing that Starwood news yesterday, I went down a rabbit hole on the UAE's actual exit filing. That basically rewrites everything we thought we knew about global supply discipline. It's a wild morning to be reading the fine print. Yesterday, I was reading the Axios Markets report while my coffee was getting cold. And I realized we're not just looking at a price spike in oil. We're looking at a complete architectural redesign of the energy market. When oil tops 120, like it did yesterday, USO up almost 8%, everyone looks at the Hormuz standoff. But the real story is that UAE exit from OPEC, which starts tomorrow. That is the clearest signal yet that the old map is being torn up. The UAE wants to maximize their own capacity while prices are high, and they're basically saying the cartel's discipline is a relic. It creates this weird paradox where we have higher prices right now because of the geopolitical premium and the Hormuz risk. But eventually we're going to see more non-cartel barrels hitting the market from places like South America. Shell just inked their biggest deal in a decade to secure that supply. It's a structural rewiring. Companies are incentivized to build new pipelines and drill in safe zones, because the Strait of Hormuz has become a single point of failure that the market finally decided to price in. And then you have the absolute irony of France leading a summit yesterday to push for a total shift away from fossil fuels. I mean, the timing is just incredible. It's like trying to lecture someone on the benefits of a vegan diet while they're currently starving on a desert island and just found a crate of canned ham. France is looking at the long-term demand destruction, which is fine. But the market is screaming about the immediate supply reality. And that disconnect is why the energy infrastructure names were bid so hard. Alex, with gold breaking down 3 days running and yields holding above 4.4. Does the bond market actually believe inflation sticks, or is the oil shock just messing with the signal?
The bond market's actually saying inflation sticks, the 10 years up 6.4 basis points today at 4.418, and that's independent of the oil. Shock because the 3-month bill is still sitting at 359. So you've got this inversion that won't compress, which means traders are pricing in either persistently hot core inflation or the Fed staying higher for longer. The oil shock gets blamed for volatility, but that bid at the long end is the market saying the baseline is genuinely sticky.
That's exactly it. And that bond market pressure is why the gold chart looks so broken right now. It's fascinating because normally you see oil 120 and the Strait of Hormuz in the headlines. And gold should be the only thing people want to own. But it's down 3 days straight. that tells you the real yield story. The interest rate you get after accounting for inflation is finally biting. If you can get a guaranteed return on a treasury that's actually meaningful, the insurance of gold starts to feel really expensive to hold. It's a total shift in portfolio construction. The market isn't looking for a bunker anymore. It's looking for liquidity and yield, even if the world is on fire. It's like people are willing to let the house burn as long as they're getting paid a high enough interest rate to sit on the lawn. And speaking of people doing questionable things for money, did you guys see the Nigel Farage headlines yesterday? A £5 million crypto gift from a billionaire that he apparently forgot to disclose? Beyond the politics of it, it highlights this massive loophole in UK finance where crypto is still a ghost in the machine. If that was a bank transfer, the red flags would be visible from space. But because it's on-chain, it sits in this regulatory gray zone. It's going to force the hand of the regulators in London. They can't talk about being a crypto hub while the most famous politician in the country is using it like a secret campaign finance cheat code. But the real check your locks moment from yesterday was in the REIT market. You have Starwood halting redemptions, basically telling investors no, you can't have your money back, because the commercial side is just bleeding. But then you see Avalon Bay and Equity Residential talking about a massive merger in the residential space. It's a complete bifurcation. The commercial guys are freezing the gates because office towers are ghost towns, while the residential giants are consolidating power because even if the Fed stays high forever, people still need a roof over their heads. It's a defensive merger. They're building a fortress against the very liquidity crisis that's currently swallowing Starwood. Tom, does this look like a controlled demolition of the old real estate model to you? Or are the residential guys just whistling past the graveyard?
It's neither. It's a liquidity event wearing a blazer. When funding gets tight, strategic merger usually means please don't make me mark these assets honestly. The only question is whether combined they can push rents faster than their cost of debt. Because if not, it's just a bigger problem.
A liquidity event wearing a blazer. Tom, that is the most accurate description of the REIT market I've heard all year. But look, it isn't just the real estate guys playing musical chairs. You see that same sense of just keep the lights on over in Sydney, where the ASX named Darren Yip as interim CEO yesterday. It sounds like a boring HR update. But when a major global exchange is operating without a permanent captain during a period of massive volatility, it creates this subtle layer of operational risk. Markets hate a vacuum, and leadership uncertainty at the exchange level makes people wonder if the plumbing will actually hold if we get a real flashpoint. And while the front door is getting more expensive, capital is finding some really interesting side doors, like the Hong Kong local bond market, which turned into a total funding hotspot this week. You have these firms that can't refi through traditional channels because the rates are just punishing. So they're shifting their entire capital flow to local alternatives to survive the squeeze. It's all part of this grand reshuffling. Everyone is looking for a place where the math still works and the infrastructure is solid, which is exactly why the big tech names have been able to ignore the gravity that's pulling everyone else down. Tom, you've been looking at the actual hardware and energy pipes behind the AI trade. How much of this resilience is just superior engineering versus just having a bigger pile of cash? Take us into the nerd corner.
Alright, so the split this morning actually makes sense once you stop calling. Both of them AI companies, and look at what the AI is doing for each business. Because it's not the same job. Meta's spending is defensive. Google's is offensive. Meta is buying GPUs, building data centers, hiring researchers to stop their core product from eroding. Their ad model is interruption-based. You're scrolling. They shove something in front of you. TikTok made that dramatically more efficient. So now Meta has to rebuild discovery, recommendations, creative, all of it, just to keep you there long enough to show you an ad. The AI spend is the moat repair kit. Google. Google already owns intent. You type what you want. That's the whole game. So when they spend on AI, it's not to defend relevance. They already have it. It's to make the machine that monetizes intent more efficient and eventually more dominant. Better answers, better targeting, better conversion, same monopoly, just tighter. Now layer in the thing we talked about in episode 3, the nuclear contracts. This is where it gets uncomfortable. Google went out and locked in nuclear power purchase agreements, 10, 20 years, fixed cost base load energy for their data centers, which means the biggest input into AI compute power is effectively pre-priced. So when the 10-year is sitting at 4.418, and everyone's doing this duration math, 20 basis points higher, that's a 25% hit to valuation. That math assumes your costs float with the market. Google's don't, not in the same way. Meta is funding this build-out at market rates, competing in an arms race for attention. Their cost of capital moves with yields. Their infrastructure costs move with energy. Their returns are uncertain. Because TikTok exists, Google is building on contracted nuclear power to protect a monopoly that prints cash the second someone types a query, same AI capex, completely different exposure to rates. That's why you get this tape. Meta misses, guides heavy. Spend stock down almost 9%. Google beats, same theme, stock up 6. It's not the spend, it's what the spend is securing. And then you've got AMD up 2 and a bit pre-market. Because the shovel seller doesn't care which king wins the war, as long as the war keeps going. Which, by the way, it will. Because neither of these companies can afford to stop. One's defending gravity, the other's reinforcing it. So the real question is, if rates back up through that 445 level we've been watching, which model actually breaks first? Alex, Ray, where do you want to push on that?
Meta breaks first. They've got no fixed cost floor on the infrastructure. If the 10-year pushes through 445, their cost of capital goes up, their build gets more expensive, and their advertisers tighten because consumer credit contracts. Google's got the nuclear contracts locking in energy costs, and search intent doesn't crater the same way interruption ads do in a downturn. So Meta's facing 3 headwinds at once. Google's facing one.
You're spot on about the headwinds, but there's a pivot point here that's even messier. If that 10-year move through 445 happens because the PCE and ECI data today come in hot, then it's not just a Meta problem. That's the moment where the Fed's hands get super glued to the no-cut button. And the entire AI capex bet has to reprice against a world where higher for longer isn't a threat anymore. It's the floor. Even Google's nuclear moat starts to look a little shallow if the discount rate for every dollar of future cash flow just steps up permanently.
Yeah, and that's where the tell today is almost stupidly clean. Watch Nvidia. Because it's the one place both arguments are alive at the same time. The bear case is rates. 10-year goes through 445, multiple compresses. 35 times earning suddenly looks ambitious. The bull case is nothing has changed. If anything, it's worse. Because Meta can't stop spending, Google won't stop spending. And every dollar of AI capex still runs through them. So you've got duration math on one side, and a literal capacity shortage on the other. Same stock, same day. Completely different religions. If Nvidia closes red, on a day where Google just printed and told you demand is real, that's the market saying we don't care. Rates are the story now. If it holds green, even a little bit, That's the infrastructure trade surviving another round of higher yields. That's the whole game today. All right, let's put some money on it.
All right, so we need to do something embarrassing here. We completely forgot to score episode 17 last time, which is wild because we had a perfect sweep that day, and nobody told anybody. 3 clowns, ladies and gentlemen. Let me fix that right now. Episode 17, due Monday, April 28th. Tom called the QQQs close red down. About 1%, the QQQs closed down exactly 1.0%. That's right. Ray called the 10-year Treasury closes above 435. It closed 435.4. That's right. My call was AMD closes above 320 AMD. Closed 323.21. That's right. All 3 of us right on the same day, and we just didn't mention it. Okay, now episode 18, which we're scoring right now. Due Tuesday, my call was the QQQs close red, down at least half a 2%. The QQQs closed up 0.61%. That's wrong. Powell wasn't as hawkish as I thought he'd sound. Market kept the bid. Tom called the 10-year Treasury closes above 448. 10-year closed 441.8. That's right. Ray called the gold ETF closes flat to down at least 1%. The gold ETF closed down 1.07%. That's right. So the updated scoreboard, I'm at 6 right, 10 wrong. Tom's at 5 right, 11 wrong. Ray's at 2 right, 12 wrong. Tom, you're up. What's your call for today?
Nvidia closes red, down at least 2%. I'm wrong if it finishes green. If buyers still chase it after that Google print with the 10-year at 440 plus, then rates are the story.
Tom, you're really poking the bear with that one. Nvidia has been the only thing keeping the lights on for some of these portfolios lately. But I get the logic. If that 10-year yield stays north of 4.4, the math on those high multiple tech stocks just stops working eventually. I'm looking at that 8:30 data drop. We have GDP and the core PCE hitting at the exact same time. With oil over 120 and the UAE walking away from OPEC yesterday, it feels like we're staring at a classic stagflation setup where growth slows but prices keep ripping. My call is the gold ETF finishes up at least 2% by the close. People are starting to realize that if the Fed can't control energy costs and they can't jumpstart growth, they're going to have to let inflation run, and that is pure oxygen for metals. I'm wrong if the advanced GDP print comes in surprisingly strong, let's say above 2.5%, because that would give the Fed cover to stay aggressive and that would drain the safety bid out of gold.
Ray, gold's already up almost 2% pre-market, so you're basically calling it holds or creeps higher through the close. That's smart positioning ahead of the data. But yeah, if GDP surprises north of 2.5, you're toast. My call is Meta closes down at least 3% by the close. The 830 number either confirms the stagflation thesis, in which case, rate-sensitive discretionary gets hammered harder than Nvidia does, or it doesn't. And Alphabet's already priced in the upside from the infrastructure bid. Meta has nowhere to hide either way. I'm wrong if Meta finishes green.
So all 3 of us just said rates decide everything and picked different victims. Meta's just the one with ads instead of GPUs. All right, let's see who gets punished.
That's the beauty of it, though. We're all just betting on the same thing and hoping we picked the right loser. Thanks for tuning in, folks. See you tomorrow when we find out who actually knows what they're talking about.